Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And a lot of investors are asking about where equity markets are headed next. So we're going to try to answer that question during today's session. So before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. But a quick reminder, a bit of housekeeping here. Tomorrow afternoon, I'm doing a special session with Tom Sosnoff, an introduction to small futures. This is a new futures exchange that is, in my opinion, very well suited for retail traders who find futures perhaps a little too large or perhaps too confusing. The new small futures product is really simple. They're really standard. So it's easy for investors who have smaller accounts to trade and get exposure through the futures market for different asset classes like interest rates, commodities, and even indices. So I'm going to be doing a separate session with Tom tomorrow afternoon at 4:15 p.m. Everyone here who's a member, if you're a free trial, you're already registered for this. You don't have to do anything extra. You're going to receive an email notification in your inbox this afternoon, and again, a reminder tomorrow afternoon to show you how to access this session. So really looking forward to this, especially for those of you that trade ETFs, whether you trade GLD, SLV, you trade TLT, you trade UUP, the US dollar, and you're gaining exposure through ETFs. Futures products may be a better suited product for you to gain exposure to some of these other alternative asset classes outside of equities. So really looking forward to that session with everyone. So we'll start off today as we normally do with our major market update with the major indices where they currently sit. We have quite a bit of a shift here over the past couple of days in terms of major indices. So we'll show you what our views are and how we're interpreting that. Fixed income markets also seeing quite a bit of movement here. So we want to take a look at where we are paying attention to within the fixed income space. Commodities, quite a bit of movement here from gold, quite a bit of movement and potential outcomes here for energy. So we want to take a look at crude. We'll take a look at the sector rotation data, looking at all 11 sectors, where we're seeing some leadership, where we're starting to see some improving and lagging sectors. Some of the improving economic data that actually is supporting and starting to surprise to the upside after spending quite a few months looking kind of sideways and starting to even slow down a little bit on economic data. We're starting to see some surprises to the upside, so we'll point you there and then share with you some of our ideas as far as how I'm viewing the opportunities in the market based on where we see the broader equity market outlook. But the primary question that I want to help investors answer from today is really, are markets ready to resume another leg higher? This really comes from where the current markets sit in terms of the major indices, and I want to make sure everyone has a good sense for how to look at the broader markets. So I want to share with you my technical research, my charts to help inform those trading decisions. So when we start off by taking a look at the S&P 500, we've had a pretty strong breakout here over the past couple of days above that all-time high. So we've pulled back here to the 371 support level, which has been a major support level here for quite some time. Pulled back here, quickly resumed back to the all-time high, paused there for a couple of days, and yesterday we saw the breakout here above that 393 all-time high. So this certainly puts the S&P 500 back into a bullish phase. And then when we look at the QQQ, the NASDAQ 100 index, clearly not as strong. But the one thing I want to point out here is that the Qs held this 298 support level here. That's constructive because you've had a big move here to the upside that has gone uncorrected. You've gotten a correction all the way back to the breakout level, and you've bounced higher. Now, the 21-day moving average, which has largely been the resistance level throughout the sell-off, has now been broken to the upside. And from my perspective, I think you will likely see the QQQ break back above to that 339 all-time high. And if it can break back above that level, that's really where we would say all markets are firing on this bullish cylinders. But for now, the S&P 500 back into bullish phase, the QQQ back into the neutral, slightly, I would say mildly bullish phase, But then if you look on balance of the other markets, IWM breaking above all-time highs here to 240, above that 226, 227 level here, breaking above that all-time high. So when you have small caps, Russell 2000 breaking to all-time highs, S&P breaking up to all-time highs, Dow Jones breaking out to all-time highs, and the RSP, equal weight S&P 500 index, outperforming the S&P 500 market cap index, this on balance looks fairly constructive and a fair amount of confidence that I could put behind the equity market rally when we see all of these market indices making new all-time highs. Market breadth looks extremely strong, as you can see in the RSP leading the S&P 500, meaning the broad-based S&P 500 stocks is performing better than the top few stocks in the S&P 500. That's constructive. And the only indice that's lagging behind here is technology, which has been in the leadership position, is now taking a backseat position here, perhaps coming back into leadership again too, but that type of rotation is healthy. You don't want to see one sector like technology leading the markets higher and only that sector leading the markets higher. That is not a healthy market rally, but the rotation we've seen here over the past month or so, that's healthy. And I think the fact that we've seen these markets resume to new all-time highs, that is constructive and provides quite a bit of confidence in the current market rally that I'm seeing. The one thing that we also want to pay attention to here is this value versus growth chart. We've talked about value underperforming growth for quite some time in terms of multiple years. We've talked about this bottoming formation that it's put in here over the past year, and over the past few weeks, it really broke out here to the upside. So this was the first time we've really seen value outperform growth here in multiple years. Now, the question is really, how long can this last? Is this just a 2-week fizzle that's gonna fade out and come right back? Or is this going to be the start of a longer term trend here in terms of value? That's yet to be seen, but it is touching this resistance level here, and it's so far failing at that resistance level. So that is one that we're paying attention to. Perhaps this bottoming formation is not complete. Maybe this is just another consolidation phase after a long downtrend. It consolidates and then starts to continue to underperform again. That's possible. I would really like to see a breakout here above this 65 level to confirm that this bottoming formation is complete. Until that happens, it's not quite yet complete. So value versus growth, still a little bit undecided here, but potentially over the next few weeks, if we start to see this growth outperform value again, that could be, in my opinion, the end of this rally we've seen in terms of value. When we look at the 10-year yield, which has largely driven the volatility that we have seen here over the past few weeks, we've seen this big move here from 120 to 160 basis points. So far, the last few moves higher here, as you can see, is starting to see a bit of exhaustion here, as higher highs in yields have not been confirmed by higher highs in momentum, a little bit of negative divergence. That points to me that you're going to likely see some consolidation here over the next couple of weeks, maybe back into that 140, 160 range. So that's going to likely provide, in my opinion, some support here for equities to rally here going forward. So when we take a look at the sector rotation data, what's really led the markets here over the past few months has been financials and energy. And over the past 10 days, we've really seen a significant decline here in financials and energy in terms of leadership. They've actually now, they're now in the weakening category here. Both industrials and materials remain in the leadership camp, but as you can see, they've started to also lose some relative strength here and lose some momentum here over the past 6 or 7 trading days. And what we really see to start to see a heat up a little bit is utilities, consumer discretionary, consumer staples, starting to improve and starting to see some increase in momentum from these 3 categories. So this is those are the 3 sectors that I would start looking into and start paying attention to. We still have this stealth rally here in healthcare, but as you can see, it's not really moving much. It's moving a little bit, improving just by little bits amount, but can't seem to get into that leadership category here. But consumer staples, utilities and consumer discretionary looking fairly strong. Communications also improving, but over the past couple of days, coming back down a little bit. But this is one that I could see sneak into the leading category here over the next couple of days, especially if we take a look at some charts of XLC in a few minutes. And real estate, providing a bit of a thrust here, hasn't quite gotten into that leadership or improving state yet. And technology is still in last place here. But again, over the next few trading periods, I think we could start to see technology start to rotate a little bit to the upside. So that's where we currently sit on the sector rotation side. And if you look at this, we see a fair amount of healthy rotation here, right? It's not just technology or energy and financials leading the markets higher, which we have seen for about 5 weeks or so. Financials and energy have been the leader of this particular sector rotation. But over the past 10 days, we've really seen this healthy amount of rotation. Two top leading sectors, energy and financials, weakening, and materials and industrials starting to weaken a little bit as well. And then this group here, utilities, staples, and discretionary starting to lead. That type of rotation, again, also healthy to see that during a market rally. So when we look at the fixed income side, TLT, major sell-off here in TLT over the past few months. And we've really reached what I would consider a bit of an extreme level here. You have TLT, RSI reaching below 20, two multiple swing lows that have not been confirmed by momentum. So you have a bit of positive divergence here. This usually points to a potential bounce here in TLT. So I certainly think TLT near a bottom here on TLT. And also, if you can see here, reaching that 618 fib level here, which is around 134. Corresponds to the 200-week moving average. So you have a fair amount of support here, looking for a potential bounce here on TLT. And the one thing I did point out here last week that I think is important for investors to pay attention to here is the fact that, as TLT sold off, we also saw investment grade sell off as well. Now that's concerning to me when you see risk-free assets like Treasury sell off, and in what looks like a risk-on environment, you would normally see buying of riskier fixed income products like investment grade and high yield. So we saw that huge sell-off on LQD alongside with TLT. That's not a very strong vote of confidence from fixed income investors. But I will say there is a silver lining to that, and that is the fact that HYG, high yield, has outperformed LQD, investment grade. So as long as the fixed income investors are moving, they're selling TLT, they're selling LQD, and they're buying HYG, and there's leadership in HYG, high yield, and they're going further out into the risk spectrum, that is going to be, I would say, okay for that sell-off. But this is one that we're monitoring very closely because HYG versus LQD is near a major resistance level. Because if we start to see some sell-off here, meaning LQD starts to outperform HYG, and they're both still selling off in conjunction with each other, that is concerning to me to the broader confidence that we're seeing from fixed income investors. But we haven't seen the reversal yet, and so far right now, HYG high yield continues to outperform investment grade, but one worth paying attention to. Looking at commodities, gold has seen a pullback all the way now down to this 157 level, which has been the resistance level, the breakout level from earlier last year. Managed to get all the way back here. If you missed out on that big rally from 157 to 190, we've retraced 100% of it. And the question is whether we're going to start to see a bounce higher here. You certainly have what looks like a bit of a, let's just call it a flag formation here after what is a large move here to the upside from that 115 range. So it's not uncommon to see a fairly large consolidation period when we're near the bottom of that channel, and the very least potentially targeting back to the top of that channel. So if we look at this on a daily chart here, this is the channel that we can draw here on GLD, perhaps a resumption back to that 168, which corresponds with a major resistance level here that we have seen, or support level we have seen here on GLD. So perhaps getting back to that 167, 168 level here. Silver looking much stronger here than gold. So gold perhaps playing a little bit of catch up here over the next few trading sessions, as gold also reaching this severely oversold condition that we rarely see on gold, that usually leads to a bit of a rally here on gold here. So moving over to crude here, we've seen crude also lose quite a bit of momentum here as it continues to make higher highs here over the past few weeks. As you can see, strong negative divergence here on crude, and also crude coming across some major resistance level here around around 60, 68, 67 or so. That major resistance level perhaps taking a bit of a pause here, and this is what's driving some of the this is what's caused the pause, if you will, in XLE. That strong, XLE, the best performing sector here since the election, perhaps seeing a bit of a pause here to that rally as crude starting to see some exhaustion, starting to see that negative divergence. That points to me that you're likely to see a little bit more consolidation rather than further upside here for crude. And then if you look at XLC, this is really where we see some leadership here out of all of these sectors that I think is worth paying attention to, because over the past month, as things got very volatile, XLC really held in fairly well, playing quite a bit of defense. And now that things are stabilizing a little bit, XLC breaking out to new all-time highs. So this is constructive, I think, for XLC. You have quite a few names within the space like Dish Network, Disney, that are opportunities, and in my opinion, for breakout here for the communications sector. And even for those that are looking for a little bit more riskier on the risk spectrum. And I think, as things stabilize here over the last couple of days, this is where you can start to look a little bit further out into the risk spectrum. ARK did get back all the way to this 106 level, which is the breakout level that it had right after the election, came all the way back, retraced 100% of it, and now back to its 21-day moving average. 21-day moving average providing resistance throughout the entire sell-off. We've now broken back above that level, and I think potentially targeting that 160 all-time high is reasonable, similar to what we're seeing here in QQQ. As you can see, ARK also getting all the way down to that 20 level here on the RSI. Finding some stability, getting back above that 21-day moving average, that would be the vote of confidence, in my opinion, to look to get back into some of these high beta tech names. And then if we look at JETS, the airline ETF, if you see JETS, as you can see here on the weekly chart, JETS before the pandemic really has been range bound between 27 and 32. Very strong range here. We've now broken back into that range. So I certainly think that you have potential for another trading within this particular range here. And if you look at this move here to the upside, we've really recently got a pretty sizable move on these names on the TSA news from yesterday. The one thing I will warn investors, you're going to see a lot of airlines in this particular setup, whether you're looking at Alaska Airlines or American Airlines or any of the major airlines, you're going to see a very similar setup. The one thing I will warn investors is that, as you can see here, these airline stocks making a new all-time high, as you can see, a bit of negative divergence. So I certainly think the timing on this is not particularly great at the very moment. I think you're better off waiting for a bit of a pullback here to this $27 level, then looking for opportunities. I certainly think that the timing on this, as it makes new all-time highs with that negative divergence, is not an optimal time to get in. I certainly think that there are better ways to play for opportunities in this market than chasing these types of all-time highs. Even a pullback for just a couple of days provides, in my opinion, a better entry point. So when we take a look at the economic side of things, this is really where we start to see things improve a little after spending multiple months of really stagnating and moderating from everything from employment numbers to sentiment numbers. So consumer sentiment really soured a bit here in September as the rise in number of cases continued to rise and the vaccines were being delayed. But over the past month, we started to see some of the economic data actually surprise us to the upside. So 83 was the actual number versus the survey of 78.5. And we have seen the Evercore ISI company surveys actually get back to pre-pandemic levels. So, a large decline and a kind of a choppy move back to the upside here, but finally getting back to pre-pandemic levels. So sentiment across both consumer and businesses continuing to improve. after moderating for quite a few months, moving sideways, looking like potentially even slowing down a little in terms of consumer sentiment. The previous month here in January was looking a little sour here, but now we've surprised here to the upside. So I think this is the data starting to catch up a little bit too, where the equity markets have largely priced in a lot of this stuff. The actual economic data is starting to play a little catch up, playing a little bit of support here for where the equity markets have priced in terms of the recovery. And we see the same thing across business conditions. Manufacturing index now back to relative pre-pandemic levels here in terms of manufacturing. Manufacturing remains fairly elevated here, actually remaining positive throughout the entire recovery. That's one of the bright spots, I would say, of our economic recovery. And then in terms of number of employees index 6 months ahead, meaning what employers are expecting in terms of hiring over the next 6 months, that is also looking very positive. We're talking about a decade high. So these are the types of numbers that we want to see from these economic numbers as the equity markets, like I said, have already priced a lot of this in. The equity markets have priced in a fairly strong recovery. We need to see economic numbers keep up with that expectation. And we're starting to see that a little bit after spending the past couple of months consolidating and maybe even slowing down a little on some of these economic indicators. So this is a general positive, I would say, shift in the economic numbers that we're starting to see here in the US. So looking at opportunities here in the broader markets, I think we have to take a bit of a diversified approach here. I think that there are multiple sectors here at play that you could potentially play for bullish breakouts here. One remains strong for me, are the one sector or one industry that remains strong for me is really the housing or home construction index, which falls within consumer discretionary, one of the sectors that we just showed you on the sector rotation model that is improving. So DHI just on the verge of breaking out above a major, I would say, base consolidation range here between 76 and 84 or so. You have this major support or resistance level. 84 has managed to be resistance for quite some time, just on the verge of the breakout here. Hasn't broken out yet, but I think this is likely going to see that breakout here, especially if we see some strength here from consumer discretionary. Home construction, housing remains extremely strong from a consumer standpoint. So certainly one of the stocks that I would pay attention to within consumer discretionary that's showing strong relative strength and continues to improve relative to its sector. On the reopening side, there are a lot of stocks that I think have already priced in a lot of the reopening, and cruise stocks are certainly no exception to that. But I certainly wanted to look for some stocks that still had quite a bit of upside here. So if we look at Carnival Cruise, large underperformer actually even before the pandemic, where $40 was a support level that the pandemic broke through. And then it spent the past few months really trying to find a bit of a base here, and it finally broke out above that base just a few weeks ago. Now, I think it's very possible, and most investors may have missed out on this initial move here to the upside. It did pull all the way back to that support level and held. And the fact that it got back to its recent all-time highs is breaking out higher here, currently trading around $30 here on Carnival. My target here to the upside, now that it's broken above this basing formation, is that $40 level here. So you have quite a bit of upside, 33% upside to get to that $40 level here. So while I think many stocks in this category are a little overextended, as you can see, 3 higher highs, but momentum did not confirm those highs. I would like to see a little bit of a pullback here, but I certainly think that the upside is there, and the downside is probably somewhere around the $25 level here, the breakout level here around 25. That's where I would put my stop losses if it gets below 25, but then you still have about $10 of upside here on this breakout, especially if you can get a pullback here around 27, then you're looking at about $13 in upside versus about $3 in downside. That's the risk to reward ratio that I like to see on some of these reopening trades. Some of the airlines are already back near all-time highs, or even getting into that resistance zone. Carnival is still I think has quite a bit of upside here for a reopening trade. And then on the tech sector side, we talked about ARK before. If you're looking for kind of a broad, diversified, high beta play, but then if you're looking to pick individual names, I think you want to move somewhere in the middle of the spectrum in terms of risk. Stocks that are relatively, that have strong revenue growth, stocks that have strong revenues to begin with, strong, solid revenues, not revenues that are, in the hundreds of $1,000,000 per quarter. We're talking about billions of dollars per quarter, but also not, too defensive like Microsoft and Apple, where we were during the volatility. Now that that volatility is stabilized, I think you move a little bit further onto the risk spectrum, like names like Twitter. Twitter, big breakout here from the $56 level. Did not pull all the way back, but did pull back quite a bit. And now after consolidating a little bit, finding that footing, finding that stability, breaking above that 21-day moving average. So I think Twitter potentially moving back up to that $80 level here to the upside. So that's how I'm looking for opportunities here in the broader markets, providing a different amount of risk across the spectrum, from consumer discretionary to reopening, and also within technology. These are the spaces that you want to start seeking some opportunities as you see that financials and energy rotate lower, and then you see some of these lagging sectors start to rotate into that leading category. So with that, that covers what I wanted to share with you. And just to get a little bit of housekeeping, again, to remind everyone, tomorrow afternoon, I'm doing an introduction to small futures with Tom Sosnoff. I know a lot of you love the questions that I bring here with Tom, so really looking forward to that session. I hope many of you will be able to join us on that session. We'll be able to discuss a little bit about introduction of futures and some of the products that they have that I think is extremely innovative for those of you that follow us during our market outlook sessions. We talk about gold, we talk about interest rates, we talk about the dollar. The futures market is really the only way to get direct exposure to those markets. That session is at 4:15 p.m. For those of you that are interested in that session. And then tomorrow afternoon, we're going to be, the day after, on Thursday, we're going to be talking about optimal credit spreads. And on Friday, we're going to do another members only market outlook session. So really looking forward to having everyone here tomorrow at 4:15 p.m. If you are a member, or if you're a free trial user of OptionsPlay, you're already registered for the session. You'll automatically get a reminder this afternoon and tomorrow afternoon, an hour before the session. So I hope to see many of you there. We have expanded our capacity, because many times I've known in the past with Tom on, it's a very popular session. We've reached our capacity, so we've increased our capacity so many of you can join us here during that session. So I'm looking forward to that. And with that, I want to thank everyone for taking the time out here this morning. I hope that this was helpful in giving you an understanding as to how I'm viewing the broader markets, and looking forward to seeing you guys tomorrow afternoon. Have a great trading day, and I'll see you tomorrow afternoon.